This will be the fifth rate rise this year. It's the steepest increase in rates in history, certainly since Volcker. But the background of the country today is so different than it was when Paul Volcker was chairman. We have $30 trillion of debt, the nation. The increase 1 point, if he goes 1 point on the next week, that's $300 billion of incremental interest expense. $300 billion is half of the defense budget of the United States. It's a lot of money. So the 2 or 3 rates he's done is almost $1 trillion of incremental interest expense. Now, not all our debt is floating, but a significant portion. We do continue to have to feed this deficit by issuing bonds, and it's at ever higher interest rates. The economy, if you look anywhere, is already slowing. And if you look at the signs, like I have a slide on consumer confidence, if they could put it up. I mean, consumer confidence is terrible. And where will that show up? And it will show up at Christmas. At Christmas, if you survey the consumer, half of the people will spend less this year on goods than they did last year. 20% of people will spend 50% less than they did last year. And they're doing that against piling up inventories, which you can put up the next slide. And inventories are moving rapidly higher. Companies bought goods thinking the pandemic behavior would last forever, that we're going to buy everything on site.
And by the way, all that stuff that they're on the water are already here.
It's here.
Yeah.
It's here. It's in warehouses, which are chock full. And you saw what Target did. They had the terrible quarter earnings where they had to clear the inventory. But this is just the beginning. The inventories are here. So you're going to see huge price sales of things that are in the CPI. And the CPI, the data they're looking at is old data. All they have to do is call Doug McMillan at Walmart, call any of the real estate fellows and ask what's happening to our apartment rents. I mean, the economy is breaking hard.
So, Barry, what if I said
confidence is also miserable?
You're a real estate guy. You love low interest rates. You even like inflation. So what do we expect to
Well, I think
to
the
hear
whole
from
dialogue is wrong. I don't think we need 2% inflation. I mean, inflation that's driven by wage growth is fabulous. I mean, we should want wages to go up. That'll help social issues in the United States. It's the trickle down that we've all been waiting for with low unemployment. And that actually is good. And you can pay higher rents. You can buy your equipment. You can go to the restaurant if you have high wage growth.
how hot should we let inflation run?
Inflation should run at 3 to 4%. That would be just fine. And I don't need zero interest rates. And the economy functions just fine with 2% interest rates. And it's not really the rate, the actual rate, it's the pace of the increase and the dislocations the Fed is going to cause in the capital markets. I was talking to a fellow from a big buyout shop on Friday night. They're trying to finance a take private of a large company, and the debt they're being quoted is 9%. I mean, the capital markets, you've seen IPOs grind to a halt, but nobody can buy anything right now.
What do you make, though, of rents in America and whether they're going to continue at the pace that they are? You got to look at Phoenix, up 20, 30% in some cases.
I think we own 130,000 apartments. We might be the largest owner of apartments in the United States. So we've seen 20% increases in rents year over year, almost everywhere. You can be in Albany, or you can be in Delray Beach, or in Phoenix.
Okay, but that's real money that's going to go out of discretionary buying when you're talking about some of those stores.
It's rolling over. Okay, the pace of rent increases, we're seeing it go down month to month, not year over year.
The pace of increase, but are you seeing it actually go down, or you're just seeing it plateau?
You're not. The rate of growth is slowing. That is actually the component of CPI that freaked people out last week.
Right.
But it's a meaningless number because I don't know what data they're looking at. They can call anyone in real estate, and the CPI number that's going to keep going up. By the way, you're going to see the rent component of the CPI continue to rise because it's such old data they have. But that they call us, or they call CoStar, or they call anyone in real estate, you can get the real-time data where it is rolling over. And look at the housing market. You've caused a crash of unprecedented proportions in the housing market. The economy is breaking hard.
But
500,000 single-family home sales, new sales, is the lowest since 1952. I mean, you're going to have a major crash in the housing market, and housing prices are going down. You are seeing housing prices correct. They've already took $7 trillion of wealth out of the stock market. I mean, the market is doing what it's supposed to do. We're actually breaking the market hard, and it's taking the excess out. Take the consumer that you just mentioned, okay? He's paying higher rent. He's actually paying more for food, and he's paying more for gas. So the savings he got and all the money he had in his bank account from the pandemic, I heard one banker tell me they had $2,200 in their average American savings account. That was up from $400. Pre all that money will be drained by the end of the year. So just from those three things, nothing the Fed is doing is going to change. They're attacking the economy with a sledgehammer, and they don't need to.
Shepard Smith here. Thanks for watching CNBC on YouTube.